Let's bring in Kelsey Berro. I was kind of referencing some of the stuff Kelsey was thinking about. Fixed income portfolio manager with JPMorgan Asset Management. Thanks for joining us. What's amazing is you said, there's a lot of Fed conjecture this week about what our own central bankers did, and it was dovish. It was crazy. We'll talk about it in a second. But you think the even bigger development was what happened in Japan, and we've kind of laughed about it. After their 8-year, an experiment you can do in an afternoon, okay? You try to test something, you learn it in science. An 8-year negative interest rate experiment is not an experiment. That's just a big old mess that didn't work.
Right, and they've officially exited that experiment. So what we saw this week was the Bank of Japan moved out of negative interest rates after 8 years. They also removed something called their yield curve control policy. And essentially what they're doing is saying, all right, we're going to raise up our hands and say, let's let the market dictate what the price should be and what the yields should be in JGBs a little bit more than what we've been doing, which we've been tightly controlling them for a really long time. Now, why does this matter? So I'm a global fixed income investor. Just a few years ago, you look back in 2020, there was $18 trillion in negative yielding debt in the global fixed income market. And what did that do? That caused most investors to structurally underweight fixed income in their portfolio. And honestly, I don't blame them. Who's investing in negative yields? I mean, not me. That tide has really turned in the last few years, and there's finally yield in fixed income again. And I think that Bank of Japan decision is that last puzzle piece that's really bringing us into a new era of structurally higher income. And it's a better position for investors who want a 60-40 portfolio.
Can you tell me why we keep trying either wage or price controls after? I mean, when did we figure this out, that the market needs to set prices, or else there's dislocations on either side, and it doesn't? We tried it again. We tried it. I remember wage price controls under the Nixon administration, but now we're doing it with maybe drug prices. But when do we learn why do we keep trying it again? It's going to work one of these times?
Well, for the Bank of Japan and the Japanese economy, they had a very unique situation. They were dealing with deflation, which is the ultimate number one enemy of a central bank. And so that deflationary mindset, it can become very ingrained and very hard to break out of. And that's why they went very full force over the last many years to break out of that mindset. And actually, we can debate the efficacy of negative interest rates versus some of the other things that they did, but we are seeing wage growth in Japan again, which is a really different paradigm than we've seen in the past. Now, here in the U.S., on the other hand, the Fed is worried about too high inflation, too high wage growth, looking at those trends and how they're coming down. Japan is just trying to get into a more healthy price-wage dynamic.
When you heard, okay, let's bring it home. Anyway, why was the asymmetric risk that looked to me like it was now on the economy slowing too much, or somehow Powell decided, okay, did he say up 2.5, 3 is not so bad, so we're now worried about a recession, or what caused him to take a different perspective on what the biggest concern was?
So I think we need to realize that this is not like a normal easing cycle, or at least the easing cycles we've seen in the past few, right? When did we last cut rates? It was because of a pandemic. It was because of the great financial crisis. It was because of a tech bubble. Those were, very serious situations where the Fed was responding to significantly higher unemployment. This is not one of those situations. The Fed, I would describe it as fine-tuning. And I think we need to keep an open mind to the fact that in this easing cycle, the Fed is doing it to elongate the cycle, not to respond to materially higher unemployment. And that means that it may be a bit shallow. It may be a bit more orthodox. It may be start and stop. Think about in 2015, the Fed hiked rates once at the start of the cycle, and then they waited a year until the last hike. So it's really going to be data dependent from here.
Look, it's not traditional. It's not what we've seen the last 25 years, but it's very different than what Alan Greenspan used to say. Because when we talked to Alan Greenspan, he would say, yeah, we have 2 mandates, but you really just have to pay attention to the inflation one. Everything else will follow from there. What you just described is basically saying we're not going to pay attention to the inflation part of this. We're more focused on the jobs creation and looking at that part of the economy.
Well,
that's very different.
It is a dual mandate, and so they're trying to balance both.
But most central bankers would have said, we really just focus on inflation.
And I think the inflation is still the wild card. So we get PCE inflation on Friday. The market is closed. I think Chair Powell, next Friday, Chair Powell is also speaking on a market close. So get ready for an interesting Monday morning in the bond market. But ultimately, it is the inflation data that still matters. And part of what is giving him the confidence to say, yeah, we may cut rates somewhat this year is because he is expecting inflation to continue to slow down. And by the way, if you look at PCE inflation, both headline and core on a year-over-year basis, they have a 2 handle on it. Now, it's not at 2, but it's come down about 3% from the peaks. So they've made a decent amount of progress so far.
I think it's more that we've all... So, they've already had the mission accomplished banner for the soft landing, and I think they're petrified of causing I don't know if it's a recession, but no one's expecting a recession now. That's when they come. And if you believe anything about the inverted yield curve, there's still time. There's still time for something like that to happen, and there's a lag on all these policy effects. Do they know something we don't know about? Do they see some cracks in the economy that we don't know about yet?
Well, I'm not sure if they see anything we don't, but I do think that they appreciate the lags. So I think they appreciate the fact that
you got to appreciate the lag. We need to say that. You appreciate the lag.
Yeah.
Okay, I'm going to do that.
Yeah, they appreciate that there's a lot that they don't know. And I mean, just think about where we were sitting at this table 12 months ago, and it was for certain we were going into a recession because there was a regional banking crisis. SVB had just collapsed, right? There is a lot we don't know, and I think that they appreciate that, and that's why they're in this position of max flexibility. But what we're hearing from our boots on the ground, our credit analysts who talk to the companies who are impacted by these interest rates, is they're saying, actually, this is the best these companies have felt in quite a long time. And so in our world, it's not just investing in treasuries, but it's also investing in things like investment grade and high yield credit, where you don't have to deal with the inverted yield curve. In fact, you can get yields of 7 to 8%. That's equity-like, and you're higher up in the capital structure. We think it's a pretty good time for that.